Hi, this is Christian Chase with Chase Real Estate. I've got Christy Trapachko here today. And one thing that we want to do is make sure that our investors are well aware of how appraisals work when you are financing a foreclosure property. So let's say you're buying a property to fix it up and sell it, or fix it up and rent it. You're getting a loan to buy the property, and you're possibly getting a loan to also do the renovation on the property. And so there's a kind of some things to consider is that the lenders always say, and this is something Christy and I kind of kid around about this a lot, is, the lenders are like, oh, well, we have a 5% or 10% down program. And, most lenders, just so you're aware, really want to have a borrower put 20% down to 25% down is really what the lenders want. Okay. Are there programs that exist out there? Yes. Do a lot of times the lenders that are making the loans for borrowers say, hey, advertise this 10% down program, but, we really don't necessarily want to lend at 10% down. We really want 20 or 25% down payment of the total project. And so I always am kind of a little suspect with lenders and when they propose these low down payment rates, because ultimately you and I both see that you're going to need a little bit more as a downstroke. And it's still not a ton. It's 20 to 25% of the total project is what you typically have to bring in. I mean, sometimes it's a little bit more, sometimes it's a little bit less. But one thing that we run into quite often is that the appraisals, they do come in sometimes light, meaning that when you buy the property here for $100,000 and our ARV is $200,000, and the appraiser comes in and says, hey, after it's rehabbed or its as-is value is only 160 or something to that part, that sometimes means you have to bring more money in to close, meaning the lender said you need to bring in 10% and now you need to bring in 20%. So to make up the difference because of the appraisal that came in. And I always say it's the lender making a decision of they want to lend what they want to lend, but they want 20 to 25% down. So just kind of have that in your mind. I'm trying to set expectations for investors that the lenders advertise that. I don't necessarily say it's bait and switch, but I don't really think that it's, completely the program that they have. And I want our investors to know likely you're going to have to bring more money in. So, but what happens is, and Christy can describe this a little bit, is what happens when a property does underappraise. And you can take it over, Christy, just explain maybe, we have some examples, but I think on top of that, where do you see it the most?
Yes, I'm taking phone calls on a daily basis from investors, and I always feel like it's easier if you hear this up front, knowing that the appraisals are going to come in low, rather than hearing it after the fact and then being concerned that something's wrong with the property that you're actually buying. So I would say 99 to 100% of the times the appraisals come in low, and we still end up selling them with, where our ARV is, we're listing them. So let's say your property appraised, and I'll give you some specific examples, but if we're saying your ARV is worth 200 and, the property is going to be worth 200 all fixed up and cleaned up, and the appraisal comes in at 150, we're still selling it at 200. That doesn't mean that, we're going to have some type of appraisal issue necessarily on the back end after it's fixed up and we go to sell it. These appraisers are very conservative. They go out there and they're seeing the properties and they're stinky, smelly, holes in the wall condition. They're not 100% sure what level you're going to take the rehab to, so they're conservative as it is. Plus, the banks want them to be conservative, like Christian was saying. So I have some specific examples for you. The first is the property at address 2622 Turtle Creek Drive in Hazel Crest. It appraised at $163,000 was the as repaired value from the appraiser, and our ARV was $215,000. And we ended up selling the property for $216,500. So you can see it appraised when the investor was buying it $163,000. I got a phone call from the investor, kind of in panic mode, but then we did end up selling it for $216,500, very close to our ARV, which was $215,000. The next example is 15104 Madison in Dalton. This one appraised at $120,000 when the investor was buying it. The after rehab value that we had on it was $160,000, and we actually ended up selling it for $190,000. So, and it appraised at $190,000 on the back end so that that buyer could get financing. So as you can see, those are two real-life examples of properties that the appraisals came in low, but we still ended up selling at or even above our after rehab value. So we don't want you to be panicked when this happens, because it's going to happen. And all it means is that you'll end up bringing a little bit more to the closing. So we say always budget, even if the loan says 5 to 10% down or whatever they're saying, always keep in the back of your mind, it's probably going to be 20 to 25% down. If you just keep that in the back of your mind, then when the appraisal comes in low, you're not shocked, because we're telling you now to expect that. And then, we'll still sell it for our after rehab value down the road.
And I think you touched on it just for a bit, but the appraisers, and I don't think that the appraisers are necessarily wrong. I think the appraisers are really concerned, meaning they're nervous for their job, okay? So when they go in and you buy a foreclosure property from Christy and I, and this place is just a disaster on the inside. Holes in the wall, mold in the basement, water, and everything is all torn up. The appraiser walks through that property and they have to visualize what you're going to do. They have a little scope, and they're like, well, they're going to fix up this house. But do they really know what you're putting into the property? No, because they can't visually see the materials that you're putting in. They have to assume what you're putting in. So they get very, very conservative. The appraiser does. They get very, very conservative because they have to kind of guess what you're going to do. And if you don't do the right things to that property, that appraiser's license is essentially on the line, because they said the home was worth $200,000, which our ARV was, and you did a really lousy rehab on it, and then ultimately the home sells or you go into foreclosure or something like that. That's what the appraiser is so fearful of. And so you kind of have to remember, that's our business, what we're in. For 26 years I've been doing this and this type of financing. I've always known how the appraisers are. I think appraisers are awesome. I've been very, very pleased with the appraisers over the years, but I do get when they're trying to do the crystal ball thing and figure out what your property is going to look like. They're going to be much more conservative than what I know what your property is going to look like, or Christy does. We know what our client's end product looks like. If you're using our renovation teams that we work with, we know exactly what it's going to look like. If you're doing it yourself, we can make the assumption, and we're going to be guiding you through on what you should be doing in rehab. But Christy had some really good examples here, and we've got hundreds and hundreds of these. I would say it's more of the case of it happens more often than less often.
Mm-hmm. Almost 100% of the time.
Okay, so if it's 100% of the time, then we're right there. So it's just something to consider. We wanted to make sure, set expectations for our investors, make you aware, hey, this is part of our business. And when the lender says 5 or 10% down, I listen to it. And then when I need to be bringing in 15 or 20% or 25% for the down payment for the total project, it's not a big shock, and I'm not worried that the appraiser came in at $160,000 and our ARV was $200,000. That doesn't mean the home is worth $40,000 less. It means you've got an appraiser that's conservative. They don't know what this work is going to take to get the property into $200,000 value, and they're covering butt is essentially what it is. So again, thanks a lot for tuning in here. And always check out our website, chaseforeclosure.com. Thanks.